And what we're going to be talking about in this first session is we're going to be discussing private equity deal making and deal structuring. And so let's go right into it. We're going to have at the end of the talk that I'm going to give, we're going to have a case which we're going to discuss, which is a venture VC type case, which is relevant to the current challenging times. So let's start with just reminding ourselves about how the private equity investment process works. If we see this slide here, um, we have a certain sequence of things that need to happen for a private equity deal to go ahead. There's going to be a valuation involved. There's going to be negotiations that take place with the company and the shareholders. There'll be some internal approvals. I've mentioned the investment committee. There'll be some due diligence that goes on into the company, and then following the due diligence phase, there'll be a kind of final closing where legal agreements are concluded, and then we go into closing and into implementation. So this is an investment process it's not just specific to private equity, but it's the normal sequence we would expect to see in any deal. So what are some of the key building blocks that go into any deal? It's going to be the valuation of the investment upon which we're going to construct the deal. It's going to be the due diligence process of analyzing the company and making sure everything is okay. That's another major building block. And another building block is going to be the negotiations and the actual structuring of the deal, around building upon the pillars of valuation and due diligence. And then we're going to have the legal agreements, putting everything into an official form. So that's the approach in private equity to any investment transaction, and that doesn't change. That's not going to change in the current situation either. So let's start with discussing due diligence. So yesterday we covered valuation. So let's cover a couple of other aspects which are important when it comes to constructing and structuring a private equity deal. One is so this is due diligence, and the first question we can ask ourselves is, well, why do we conduct a due diligence? What's the purpose of it? And the reason we conduct a due diligence is that what we're trying to do when we are conducting due diligence is we are trying to establish what are some of the hidden risks that may be attached to the transaction. So that's one of the things. What are some of the problems that may be there that we're not aware of at this point? And the second part of due diligence is to unearth any kind of secrets or any kind of items about the business we're not aware of that every business tends to have. And then thirdly, we want to establish the level of corporate governance that a company may have. That may be, for example, figuring out that whether the company's accounting system is a manual system, or is it based upon Excel, or do they have a more sophisticated software. It's to assess the level of legality, of whether it owns its assets and whether everybody's properly employed. So that will give us a general picture of the company's corporate governance. Are the company's accounts audited? Does it have one set of books, or does it have two sets of books? And so these are all things we will try and establish during a due diligence exercise. So the exercise is really fundamental, because we need to do that exercise in order to get these very important questions answered. And the fact is, we can't actually proceed with structuring a deal unless these questions are answered in a way that we are comfortable with the answers. So when we're talking about due diligence, when does it start? Well, the due diligence, it sort of starts and proceeds in parallel with some other parts of any private equity investment. Typically, a due diligence would normally, ideally, as a matter of best practice, start once a term sheet is signed. So a term sheet is also known as a memorandum, MOU, some people call it, a preliminary agreement, a non-binding agreement. So this is an agreement signed between the parties somewhere at the beginning of the transaction to put down on paper the kind of general points of understanding that have been reached about valuation and other important aspects of any deals. And so that is one of the key points. In practice, it may start earlier, and we also have to make the distinction between a kind of a pre-due diligence we might do, um, which is before we actually appoint external experts, such as accountants and lawyers and others, to start conducting due diligence. We, as the fund manager, would be doing some due diligence by ourselves before we appointed them, in order to get a general top-level picture, and that would allow us to do two things when we move into the formal due diligence process. And the first of that would be it allows us to see if there are any obvious big problems or any red flags, as we would call them, that are obviously there that we could not do the deal. That would be one objective, because there's no point in spending all this money on due diligence if that's not the case. And the second thing is we would use this preliminary process to allow us to understand what kind of work we want the advisors to do in the formal due diligence phase. So what we're basically doing is we're going to be developing the terms of reference for the advisors and the consultants during the formal due diligence phase, so that we have some idea of what kind of assignment we want to give to them. Another thing that's important to notice when we're talking about due diligence is that due diligence does have a cost attached to it. These accountants and lawyers and others need to be paid. And so one of the issues also that is an item for negotiation or for agreement is who is actually going to pay for the costs of due diligence. And really we have several choices, several candidates for paying that. One potential candidate to pay the due diligence costs would be the company that is receiving the investment. Another potential candidate to pay for the due diligence costs would be the fund, the private equity investor, the investor who would be paying. And then we also have to, so those are two possibilities. And the other thing we need to bear in mind is also what would be the payment arrangements in the case the deal is a successful deal and the deal is closing. And the other question is, what would be the payment arrangements in case the deal doesn't go ahead? In other words, the due diligence goes ahead and money is spent on due diligence, but no final agreement is reached, or the deal goes away before it is reached. So those are two variables which are also quite significant. And so when it comes to considering the cost of due diligence, the other factor that comes into play is a cultural factor. So, for example, from my experience, investors in the Middle East or the Gulf region, the tradition seems to be that it's the investor who pays for their due diligence. In other places, like for example in Europe, it's usually a negotiation where it's more common that the company will pay, or that the cost will be shared between the company and the investor, with maybe one arrangement in case of a successful deal and a different arrangement in the case of an unsuccessful deal. So the matter of how due diligence is organized, who's paying for it, under what conditions, is a big part of deal structuring, and also needs to be understood and borne in mind and quite carefully considered. The other thing to perhaps just worth mentioning is that we can also make the distinction between the buy side and the sell side due diligence. Um, a buy side due diligence is the due diligence that would be performed by the investor into any company, and the investor would rely on that due diligence in order to make the final investment decision as to whether to proceed or not. The sell side due diligence is sometimes performed by the company owners or the company management in order to facilitate an investment. This would mean that the company would commission some experts to do a kind of diagnostic of the company, known as a sell-side due diligence, in order to have a better understanding of the company's situation themselves, and secondly, to provide a signal to the investors that they are serious. And also, the sell-side due diligence can act as some kind of a roadmap for the buy-side due diligence, and the existence of having a sell-side due diligence already in place can, apart from providing comfort, can also make the buy-side due diligence more efficient and less expensive for the investors. And therefore, doing a sell-side due diligence can have the effect of encouraging the interest of potential investors into a company, if the sell-side due diligence is performed. Typically, the cost of a sell-side due diligence might be something like 20% or 25% of the cost of a full buy-side due diligence. So those are some considerations about due diligence as an important part of the of any investment. How is due diligence going to be different now? Well, I think it's going to be, deals that are going to be happening in 2020. It's going to be pretty much the same. There might be some more emphasis on certain aspects which may be relevant to what's going on now, like, for example, on receivables or customer retention, or some other such aspect that may be relevant, or some kind of hotspot which has been triggered by the current situation. So let's now move on from the topic of due diligence, and let's go on to discuss what kind of financial instruments that I'm going to make use of in order to structure a deal. Because let's remember that we have several building blocks that go into any private equity deal, apart from the due diligence, which we've just talked about, apart from the valuation, which we discussed yesterday, apart from the legal documentation, which I just mentioned earlier, which is the term sheet followed by full legal documents. We have the basic instruments which we use to make structuring of our deal. And so a deal structure is going to be created by using instruments. And there's two types of instruments that go into creating a private equity structure. The first instrument is a financial instrument, which is what you see here, the slide that we see here. And the second set of instruments are non-financial instruments, which we're going to discuss in a minute. And the combination of financial instruments and non-financial instruments are what is going to result in a complete deal structure for any particular private equity investment. So let's start by now talking about the financial instruments that we have, and I'll be reviewing each one in turn. Each one will have its own slide coming up. And so the full set of financial instruments that are potentially used for a private equity deal will include the following. On the balance sheet side, we would have ordinary shares, so full ordinary voting shares. Ranking above the ordinary shares, we're going to have preferred shares, so preference shares or preferred shares as they're known. Then above that, we're going to have mezzanine, which is a form of subordinated debt. And then sometimes, but it's the most rarely used in private equity, we would have convertible debt. Then as an off-balance sheet item, so as a derivative instrument, we would have options. And so it's possible that a private equity investment may actually be not simply a question of choosing one of these 5 instruments, but it may be a question of choosing more than one of these instruments, maybe one, maybe two, maybe three, maybe more. And some of the more complex large deals may have a variety of instruments all combined together. Some may have just one or two. Now, in order to choose the right financial instruments for the kind of private equity deal that I am planning to make, I would look at some requirements or what objectives I'm trying to achieve, and that will drive my choice of the financial instruments. And these objectives would be the following: four items. It would be the four key variables that we see here. Firstly, where would I want my financial instrument to rank in the balance sheet? So, for example, if I'm investing in a company owned by an entrepreneur, would I want should I invest as ordinary shares, or would I prefer my investment to be ranking above his shares by putting it as preferred shares? So it's about where would I wish to rank in the balance sheet when I'm investing. So that's the first consideration. The second consideration is, do I want my investment to be permanent capital, or do I want it to be repayable capital? So do I want to have a financial instrument that will has a guaranteed repayment date, such as a bullet loan, for example? So do I want my capital to be repayable or permanent, or some mix? You know, it could be repayable on certain conditions, for example. So it could be something in between the two. Thirdly, the coupon payment. So if my financial instrument has a periodic payment attached to it, such as a semi-annual interest payment in the case of senior debt, or alternatively a dividend, a regular dividend in the case of an ordinary share, or some hybrid instrument such as a preference coupon. So what kind of coupon am I looking to get, and how do I want to structure that? So that's the third consideration I would bring to bear. And then fourthly, what kind of influence on decisions that the company will make, on the company's decision making, will I have according to the type of financial instrument that I choose to have. So, for example, if I'm an ordinary shareholder, I will have a vote in the shareholders' assembly and perhaps the right to nominate board members. If I'm lending money as a debt provider, I will have loan covenants which I can enforce if the company is not respecting those loan covenants. And then we can have a variety of other mechanisms to influence decisions. So those are going to be the instruments which are available to the investor. So if I'm a private equity investor, I can choose, and I'm seeing a question which I think I'm just answering now. So if I'm a private equity investor, I can choose for one deal that I would like to structure my investment as ordinary shares. On another case, I may decide I would like to structure my investment as preferred shares. In another case, I may decide to put some of my investment as ordinary shares and some of my investment as preferred shares. In another case, I could, for example, put some of my investment as preferred shares and then have part of the investment as mezzanine shares, but not do it myself, but have a colleague of mine with a mezzanine fund and invite him to join me, and he could put in the mezzanine finance. So all these combinations are possible, and this is something that's done quite frequently. How often you use the different share classes depends a little bit on the type of deal and on the jurisdiction. So, for example, if you're doing venture capital type deals in the US, you're going to have many different types of share classes. The companies may have Series A, B, C, D, and E. They may have 6 or 7 different share classes. Other types of deals, like maybe a growth deal, you might have ordinary shares combined with some preference shares as well. And so the use of different share classes is quite frequent, but it will depend on the type of deal and on the jurisdiction in which the investment is made. In some markets, which are a bit less developed, less share classes are used because it's more complicated for people to understand. So the use of different share classes is very frequent in some private equity markets and less frequent in other private equity markets. So let me say a few words about um, these different types of financial instruments and how these are working for private equity. And so if we consider firstly the financial instruments, so ordinary shares, so normal shares, we can more or less, when we analyze the financial instrument from a private equity point of view, the way to look at it is to divide the ordinary shares into three different categories, which will have a different dynamic. Each of the three categories has a different dynamic. So let's deal with the first one, which is having a small minority stake. So if the private equity investor has a small stake of something like 10% or something like that, honestly, that's not really a private equity investment because it doesn't allow you to have the level of influence that a private equity investor is looking to achieve in the company's decision making. So having a small minority stake would give the investor not much influence. It would give the investor a stake which has not much liquidity, which is difficult to sell, particularly as it's in a private company. But I would qualify that if the investor is part of a group of investors which collectively own a bigger stake, then that's different because they will act collectively. But if the private investor acting alone, buys a 10% stake, that isn't a good place to be for a private equity investor because it doesn't give you that influence. So that's the kind of small minority stake. The second category we can see here is what I've described as the influential minority, and this refers to having a stake which is it's difficult to estimate exactly the range, but it's up to 49% and down to say 20%. And this means that you don't actually have a controlling stake, but you have a strong influence. So this is somewhere where probably most of the private equity investments take place, because what you can bear in mind is that many owners of companies obviously don't want to lose their majority, and so having an influential minority means you do leave a majority stake for the entrepreneurs, for the other shareholders. So a deal can be done because they may not have been willing to do a deal giving up the majority. Although it's quite often the case that you may start off with a minority, and then over time, as people get comfortable working with each other, you can increase your stake to eventually get a majority. And so having an influential minority is a pretty good mechanism because it gives you, as a private equity investor, very strong influence. You may even have effective control if the rest of the shareholding structure is fragmented. You have 6 or 7 shareholders, each with 5 or 10%. Then if you have 40%, you have effective control. It does leave enough equity for the sponsors or the entrepreneur. So in the case that we're investing in a company which is going to be, which was 100% owned, and we're going to have 45, for example, and the original founder is going to have 55. This allows enough equity for the founders to be willing to do a deal because they'll be able to keep a majority stake, and so that's one of the advantages of this area here. Thirdly, if we are talking about an influential minority stake, it's going to be important to have mechanisms to protect yourself as a minority shareholder, particularly in those countries where minority shareholder rights are not as well protected. So, for example, in countries like Western Europe or others, minority shareholder rights are relatively well protected. In other jurisdictions, particularly emerging markets, legislation protecting minority shareholders is less developed. And so what you need to do is you need to make up for that by creating your mechanisms for protection. And those are going to be the non-financial instruments, which I'll discuss in a minute. Then we get to the majority stake, and so this clearly gives the fund the most influence because you're in control. There's less of a need to protect for protection mechanisms, but it's still maybe not total control because the other side may still have a blocking minority, or maybe actually still running the company. So I could give you an example. My first fund that I managed, was a $30 million venture fund in Europe, and our investment strategy of my first fund that I managed was that we would only take influential minority stakes. So all the investments we made, as a matter of our investment strategy, were all between 25% and 49% stakes. But other people may have other strategies. The second fund I managed was a $200 million growth fund, also in Europe. And our investment strategy in my second fund was that we only took a majority stake because our policy was we wanted to be in control of the management and to run the company. And so our policy was only to have a majority stake or even 100%. So different private equity investors or actors will have their own different ideas about what kind of financial instrument they're going to have and what kind of stakes, what kind of percentage stakes they're going to be looking for. So when it comes to ordinary shares, we should bear in mind we have to think about: is it majority, is it influential minority, or is it simple minority? Those are the three ways we can categorize the ordinary shares when we are looking at it from a private equity perspective. Then the second type of share class that we may use, which is very frequently used in private equity and even more frequently used in venture, is preferred shares. And so what is the difference in preferred shares, between preferred shares and ordinary shares? Well, preferred shares rank ahead of ordinary shares in a liquidation. So they, as a financial instrument, they rank above ordinary shares on the balance sheet. And that can be relevant when it comes to either liquidating the company or selling the company, because the preferred shareholders will get their money first. Preferred shares usually carry a coupon payment. That could be a kind of a preferred dividend, which is normally paid before the ordinary dividend. But it could also be a fixed coupon. So preferred shares have the characteristic that they can be customized much more than ordinary shares. And so a classic plain vanilla, if you like, preferred share would have lower voting rights, so they would only have a vote at extraordinary shareholder meetings, but they can be customized. And so we find that in venture investments that you'll see that many of the preferred share instruments used by venture capital investors will be highly customized. They may get special voting rights, they may have enhanced voting rights, they may have the automatic right to nominate a board member, they may have a fixed coupon, they may have a coupon which depends on profits according to a formula. So there'll be a lot more flexibility in structuring preferred shares compared to ordinary shares. And it's also quite common that you might make an investment as a private equity investor by making your investment by using a combination of ordinary shares and preferred shares. I remember I had I can give you the example of one case where I had an entrepreneur whose company was, let me just remind myself, the company was worth $2 million before the investment went in. He wanted $6 million. He needed $6 million for new investments, but the entrepreneur was insisting on 50-50. He didn't want to go below 50%. And so how did we solve that? Well, the company needed 6 million. It was only worth 2 million. So how could we do 50-50? Well, what we did is we put in 2 million as ordinary shares and the remaining 4 million as preferred shares. So we could present to the owner, the founder, that, well, we are 50-50 partners because we've only put in 2 million as ordinary shares, so we have 50-50 voting rights. And the rest of the money, the 4 million, has gone into preferred shares. And so that we sort of explain to them that that doesn't really count in a way, because you can think of the preferred shares as a kind of loan with different voting rights. And so from his point of view, that worked because it wasn't always necessarily just about the money. It was also about that the founder didn't want people in his business community to say, oh, well, you know, these guys in the fund, you work for them now. You're no longer, you know, the owner of the company. But as it was 50-50 on the ordinaries, he was able to say, well, it's a 50-50 partnership, and the other 4 million, it's a kind of a loan. And so, you know, he could present the preferred shares as a loan, and for us, it was equity. So, you know, it's a sort of flexible instrument which can look like different things to different people. Um, what about mezzanine? Well, mezzanine, unlike preferred shares, is a loan. It's debt. It counts on the balance sheet as debt, whereas preferred shares count as equity. However, there is a grey area somewhere there, because you may get a kind of preferred share which is a redeemable preference share. So a company may issue shares which are preferred shares, but the company will just redeem them after a period, like repaying a loan. So there is a little bit of a grey area. So when we go from preference shares to mezzanine, they can be, you know, hybrid instruments, which are used quite frequently by private equity investors in deal structures, particularly when you're trying to solve some kind of a problem. So mezzanine, typically you'll find that in many markets that mezzanine investment, you'll have specialist funds who specialize in doing mezzanine deals. But you also may find that some private equity funds may put in part of their investment as mezzanine for their own reasons, sometimes because they also want to appear, have the leverage of being a creditor as well as a shareholder, for example. And so what do mezzanine investors look for? Well, the mezzanine is a kind of subset of private equity. You know, if we think of private equity as the umbrella asset class, then we have four subclasses of sub asset classes. So under the umbrella of private equity, we have venture investments, we have buyouts, we have growth investments, and we have mezzanine. Let's call that the so-called European definition of private equity, whereas the American one is different. They call buyouts private equity, and they call venture, and they don't really talk about growth very much. So I prefer using the European definition, which is a bit more precise. So mezzanine investors are basically going to structure their investment as a loan plus call options on some of the company. And these are known as equity warrants. So a typical mezzanine investor will provide their capital as a kind of subordinated loan at a premium interest rate, which is typically 5% better, a higher interest rate than, say, senior loans. And then they will also be looking to have the right to buy 5% or 10% of the company for, say, $1. So effectively get the shares for free, either based upon the current price or based upon a higher price. And so mezzanine debt is ranking on the balance sheet somewhere between the senior debt and preferred equity. The mezzanine debt has no or limited collateral, because the collateral is reserved for the senior debt. So it may be no collateral, or it may have a second charge on the existing on some collateralizable assets, with the senior lender getting the first charge. And so because the collateral is limited or non-existent, the mezzanine provider is going to be looking more at the company more like an equity investor, looking at the company's cash flow as being able to service the debt or not. And so this is a kind of flexibility that we would have in mezzanine. So the best way to look at that is to look at this table here. And so we can see that mezzanine looks like equity. Why? Mezzanine looks like equity because it's long-term capital. It's not a short-term loan. It's subordinated to the senior lenders, to the existing creditors. It has an interest in the value of the company, just like ordinary shares, because they have the equity kicker, the equity sweetener in the form of those warrants. so they have an interest in the company's value increasing. And it's also possible that the periodic coupon on the mezzanine could be linked to profits. Um, on the other hand, mezzanine looks like senior debt. Um, so, for example, the obligation to repay is there, so that would be a characteristic more like debt. There may be a fixed interest payment, which is fixed as in the case of senior debt, and using a mezzanine instrument allows the investor to introduce loan type loan type covenants. I have a question here, which is what are the situations where portfolio companies resort to mezzanine financing? Well, this would typically happen in, for example, that the initial investment in the company was made by an equity fund, and the company developed and reached certain milestones and needed some fresh capital to raise some capital for further growth. But the owners, the equity owners, said, well, let's see if they cannot raise that money through a loan, so I don't have to provide more equity capital myself, so I can use leverage rather than more equity. And the company would raise some mezzanine financing because perhaps the company is still not at a point where it can raise senior debt. So if I'm an equity investor, a private equity investor in the company, and I put my money as equity, and if in 2 years from after my investment, the company needs to raise more money, and the company's doing, making more profits and so forth, then it's quite possible I would encourage my company to use mezzanine rather than me putting more equity and getting myself diluted. So that might be one example of where I could be using mezzanine. Okay, so let's go on to the final instrument, which is options. And so here, I guess you're all more or less familiar with what an option is. It's a derivative instrument, and so it's an instrument that gives you the right to buy another asset at a certain price. That would be a call option, or it's an instrument allowing you to sell an asset at a certain price, and that would be a put option. And options are frequently used in private equity, and they're very, very popular instruments. And the best way to make it clear as to how we would use options in private equity deals, and I believe options are going to be used even more in 2020 because of the high level of uncertainty. And so let me give you 4 examples of where options were used as part of a private equity transaction. So they would normally be used in conjunction with the underlying financial instrument, be that the ordinary shares or the mezz or some other, or the preferred shares. So let me give you the first example. We have a venture fund A that buys 20% of a technology company, a high-tech company, for $2 a share, and is granted the option to buy another 15% for $3 a share for 2 years by the original founders. Why would this be the case? Well, it's possible that the fund, the venture capital fund, is hesitating to buy the full 35% of the company because they're not really sure how things are going to go with the company. And they feel more comfortable just buying 20% of the company and then waiting. And then if things go well with the company over the next couple of years, they can then put in some more money and get up to 35%. But if things don't go as planned and the company doesn't do well and fails, they've only exposed themselves for 20% rather than 35%. So it allows the venture fund to sit on the fence for 2 years and not be all in right from the beginning. And the original founders may be willing to grant that option to the fund because they are trying to induce them to invest when they would otherwise not be comfortable. So that's an example of an option as being part of a package. So in this case, the fund has got an option and has put in money as, say, ordinary shares or preferred shares into the company. Here, another example of using options in private equity might be in the second example, which is referring to a larger company. This would be a buyout type deal. So we're talking about a large company, and the private equity fund that buys this company in a buyout deal. So the private equity fund buys 100% of the company and then gives options to the management to be able to buy 2% of the company for $1 if the EBITDA in 3 years reaches a certain target, and then they're given also a formula to buy another 1% if they beat the targets. So why would this be done? Well, the private equity fund is basically saying, well, what I want to do is I want to incentivize the management. I want to motivate the management to work hard and to reach those targets, because if they reach that target, the company is going to be a lot more valuable. And I would much rather own 98% of a very valuable company than to own 100% of a company that's significantly less valuable. And then for the management, they have an incentive to behave more entrepreneurially, if you like, because if they reach that target and they're able to get 2% of the company effectively more or less for free, then they can make personally some very good money. So this allows the private equity investor to align the interests of the management with their interests to increase the value of the company, rather than the management just working to get their salary at the end of the month. A third example of an option is a put option. In this case, we have a large conglomerate has decided to sell one of its divisions. Let's say it's a big engineering conglomerate, and they're selling their valves division. And the private equity fund has bought this division from them, but it wants a put option to sell the company back to the original seller if they do not respect a major contract. Now, the reason for that is that the chances are when the fund buys this division at the beginning, its only customer or its main customer is going to be the former mother company, the corporate seller. And so if this customer cancels the contract with the supply contract with this division is going to lose its only customer and is going to be worthless. And so having the put option is going to discourage the corporate seller to drop its former division as a supplier, and it will give 3 years to the fund to diversify its customer base so that no single customer accounts for more than 10 or 20% of sales, which is prudent, but it may take 2 or 3 years to reach that point. And the put option is a form of protection of the investor during that transition period, which is, a period where the company is in a rather weak position. Final use of options, we have another example is here at the bottom, where my private equity fund, and this is a case which I actually experienced as a private equity fund manager. So we had an investment it was a food company, and so the original founder had 60% of the company, and my fund had 40% of the company. And we had an agreement with the founder that after a number of years, we would sell our shares back to him, our 40% stake, based upon a multiple of the company's profits. And so, for example, in March, we could sell our shares to him based upon the profit after tax of last December of the last financial year. But at the same time, we had a call option which allowed us to buy his shares based upon the same valuation, so a multiple of profits. And our call option started before his put option. So why did we have this structure? Well, because let's imagine we only had a put option. So we would come to March, and we would be able to sell our shares back to him based upon a value equal to 10 times the profits. So this founder is also the CEO of the company and is running the company. So what would be the temptation for the founder? Well, it would be to manipulate the profits, so the profits ended up being half of what was expected, or 30% of what was expected. And then he would say to us, oh, well, that's too bad, the profits were low. Oh, too bad, your put option, you're going to sell me much more cheaply. And so the call option means that if he puts the profits too low, I may be tempted to buy his 60% instead, because he's put the profits too low and he loses the company. And so it's a way to keep the founder honest and not manipulate the profits too much. So these are 4 very different examples of where you can use options in private equity deals to resolve problems, to provide you with protection, to give incentives to people. So the options solve all kinds of different problems, and they are a very important part of any private equity deal. And we should expect in 2020 that we're going to see an enhanced use of options, particularly because of uncertainty. So we may see deal structures where we do have a lot of options on shares, where people are going to say, well, we'll simply have an option depending on how the company results go, because there's going to be so much uncertainty as to what the results could be and what form the recovery might take. So we should expect a lot more risk sharing mechanisms such as options to be part of deal structures in private equity, and hence the importance of the great importance of options in private equity, particularly in the current time. So those are the five types of financial instruments we talked about. So ordinary shares, preference shares, mezzanine, and options. I won't discuss convertibles because that's too much of those are hardly used. The main issue with convertibles is that they can rank as senior debt, but let's not go into too much detail here. So what are the typical obstacles to a successful private equity deal? Well, I've listed here the main ones in my experience as a fund manager, which I've lived through in deals that I've done. I've done perhaps in my career, I've been a fund manager for about 20 years, and I've done about 70 deals, I would say, 70 deals or thereabouts. So what are some of the main obstacles? First obstacle is valuation. So this could be typically unrealistically high valuation expectations from the seller, and that's a typical problem you face absolutely everywhere, from from Oman to Tunisia, from Italy to Sweden, from Mexico to Canada. You get the same problem absolutely everywhere. And so how can we solve this problem? Well, we're not going to be able to solve it if you think the company's worth 10 and the founder thinks it's worth 200, then probably you're not going to be able to solve it. But if there is a divergence which isn't incredibly extreme, we can solve this. We can agree to disagree, and we can structure a deal using a ratchet mechanism. We could use a ratchet mechanism. This means a mechanism according to which we take, for example, 40% of the company, and then if the company doesn't do as well, we can increase our stake if there's a shortfall in the results. Or we could structure a deal using a preference shares, or we could use options in order to overcome a valuation, a difference in points of view on valuation. And we're going to be doing we're going to discuss a case where we're dealing exactly with that problem after this session. Another issue we have, obstacle to a deal, is control. The founder will not give up control of the company, and so here what we're looking at is the expertise of a private equity investor. It's not taking over control, it's sharing control, and so that's the expertise of private equity, is sharing control, not taking control from somebody, because you can understand they would not that. And you do that by using board seats, veto rights, and reporting and having good access to information. So that's how you can mitigate the issue of control. Thirdly, we may have questions of image. So the founder is concerned, or the other shareholders are concerned with their image, with losing face. And this is an issue which is quite cultural specific. So, for example, the question of face and image, for example, is very important in certain cultures, like the Middle East or Italy. Losing face and image can be very important. In Anglo-Saxon culture, people are more pragmatic. They don't think about that quite as much. So we have cultural specifics that go into this factor. And so this is often a question of image rather than substance. And this is where the private equity fund manager should have soft skills to understand cultural factors and understand maybe emotional agendas of the parties, which are not fully just to do with the numbers. The third obstacle to a successful deal could be the question of exit. So as I mentioned yesterday, a private equity investor is a medium-term investor who needs to exit his investment after 5 or 7 years. But you may have a situation where the founder wishes to remain or wishes to leave the company to his children or something like that. And so we can find ways to structure a deal where we can do a partial exit so that the fund can get out, but the founder can continue. So that's also a possibility. Fifth, we may also get the question of complication deals. So we may get, for example, a deal that we would do in Silicon Valley, which could be a highly complicated deal, which is a Series F round with many complex preference share structures. But we're trying to do a deal in South Africa where private equity is less well known, and people may not understand the complications, or they may start to feel that it's a trick to try and steal their company from them, for example. And so a big part of the skill of a private equity fund manager is to be able to communicate and to educate people involved who are less familiar with private equity structures. So good communication and even education is also a part of solving obstacles to a successful deal. And then finally, we may also have business practices which vary. And so clearly, if you're doing a private equity deal in the UK, it's going to be quite different than doing a private equity deal in Greece or Italy, where business practices are different. And so we have to also deal with these issues if we are going to succeed in private equity, particularly when we're working in different parts of the world. So these are some of the main obstacles to successful deals, but they all have a way to be mitigated either through deal structures or through the skill of the private equity investor in dealing with them. Okay, let's now turn to the parts of deal structuring which are to do with non-financial instruments. And so here we have what I would describe as protection and control mechanisms. So if we look at the balance of power in a deal as far as company decision making, or who calls the shots in a company, we have on the majority shareholder side, we have the majority in the shareholders assembly, which leads to majority on the board of directors, and which also leads to control of management. On the minority side, which is where many private equity investors will be, you would have, for example, a blocking minority in the shareholders assembly. So in many jurisdictions, 25% plus one is a blocking minority in the shareholders assembly, and you're able to block things like capital increases and other certain decisions. Another thing is veto rights on key decisions. So you have an agreement that some decisions cannot be made without the approval of the minority shareholder. And thirdly, the minority shareholder would have seats on the board, a vote on the board, and a voice on the board of directors. And all three of these are effective levers of power and influence which can and should be deployed by the private equity fund manager. So let's start by talking about seats on the board. It's almost always the case that private equity investors will have at least one seat or more seats on the board, and that will often be in proportion to the percentage of the investment, but not exactly. And so, for the main choice the private equity investor has is, should I use the board seat and give the board seat to a member of the staff of the fund who's invested, or should we go and seek an external expert or person with a high profile to sit on the board on our behalf as an independent? So often that's the choice that the private equity investor will make, is whether they bring in a partner from outside to be sitting on the board, or whether they sit on the board themselves. And clearly one thing that's always worth repeating about boards is that they are completely different from functional management. You do not functional management, like being the sales director or the finance director or the CEO. You need to have professional qualifications in order to justify your position on the functional management. A board is different by its own nature. People are there to represent shareholder interests, and so they are not there based upon expertise. Of course, it is nice to have expertise as well as being a board member, but many board members will not be there because of expertise or knowledge, but because they represent shareholder interests, either as an appointee or as a family member or some such, or as a political appointee or something else like that. So these are also important things that need to be understood when it comes to operating in boards. And what private equity investors do, and one characteristic of private equity investors is when they do sit on boards, they make sure they have expertise, either their own expertise or they bring in somebody. So the private equity board member will have that extra dimension, that extra influence, which comes from having expertise, which the other board members may have less of. What are veto rights? Veto rights are um, veto rights are company decisions that cannot be made without my approval. So, for example, I may have, for example, 30% or 40% of the company, but I enter into a shareholders' agreement with the other shareholders, according to which there's a list of decisions the company is not allowed to make or ratify without my approval, even though I've only got, for example, 40%. And these could be things like borrowing more money, big decisions on investments, the salaries of top management, selling the company or selling other things. So there'll be a list, and these are known as veto rights, because simply I have a right of veto even though I do not have a majority on the seat. And this is one mechanism which private equity investors use to protect themselves when they are in a minority. Okay, I have one question. What happens when, following the option, the company raises more money, reducing the value of the options? Okay, let me deal with that a little bit later in the talk. Okay, let's get on to the next. I've talked about veto rights, I've talked about board seats. Let's talk about the next non-financial instrument that is essential in any private equity deal, and that is what I would describe as an exit mechanism, structured exit mechanism. So what we would have is we may have what's called drag and tag along rights in order to guarantee my exit. And the way that works is that, let's say I have 40% and the founder has 60%. A drag along right gives me the right that if somebody comes along and offers a good price for the shares, I can force the other shareholder to sell his 60% along with my 40%. In other words, I can drag his shares, I can kind of drag them with mine, drag him along. And tagging along means if somebody goes to the 60% owner and offers him money for his shares, he can't sell without me, I can tag along. And that's a way to increase the liquidity of the shares. Or it's also a mechanism that even if I only own 40%, I can offer a potential buyer 100% through the mechanism of a drag-along right. And then we have other types of instruments called floors, caps, and collars. I won't go into too much detail, but it may be the case that you may have an arrangement that you have 40% and the other founder has 60%, and you say, look, what I'd like you to do is to guarantee me that whatever happens to the company, that you'll buy my shares back from me so that I get a 10% return on my shares. In exchange, you can, if the company does really well, you buy the shares back from me so that I get a guaranteed return of only 15%, and anything above that goes for you. So it's like a floor. I get a floor return guarantee, but a ceiling on my maximum return, and that would be known as a collar. And so the 60% shareholder may agree to that, saying, well, okay, I'll guarantee the investor's downside because I strongly believe the company will succeed. And if the company does really well, I will get most of the profits that he would have got on his shares. So sometimes you do that to accommodate a different risk profile. You might have typically an investor who might be, for example, a developmental fund whose main mission is not to make a fantastic profit on their investment, but it's more important for them to protect their downside, and they may enter such a kind of investment. Okay, so those would be some of the typical mechanisms you would find. So the financial instruments that I discussed, and the non-financial instruments. And so let me say a few words about what is probably going to be an important part of the private equity landscape in the current market, which is going to be bolt-on acquisitions, and many people are expecting bolt-on acquisitions to be an important part of it. So what is a bolt-on acquisition? Well, it simply means that I'm a private equity investor. I bought a company which is, a 200 million euro company, and then once I bought the company, I sort of facilitate, or I encourage that company to start buying its competitors, its smaller competitors. So it kind of buys the company and it kind of bolts it on. It sort of bolts it on to the main company. And they're known as bolt-on acquisitions. And that's a very common strategy followed by private equity managers. And we fully expect, many of us fully expect that to become very accelerating as a type of private equity investment, which is going to take place this year because of the corona crisis. And so what kind of bolt-on acquisitions can we have? Well, we may have a roll-up type acquisition, which means that we buy identical businesses in order to gain market share, or we may do a rollout where we buy a business in a different geography or market segment to expand our footprint. Or we do a kind of bolt-on where we buy a smaller business and just attach it to us. And so these are all the ways, these are all some of the definitions we might be using when we do these kinds of acquisitions. Why do we do a bolt-on in mid-cap in private equity? Remember that mid-cap private equity accounts for about 90% of all the private equity market globally in number of deals. And most private equity deals which take place in emerging markets are mostly mid-cap growth type deals. And so, why do you do bolt-on deals in private equity? Because it's a tried and tested formula to grow more quickly than you would if you did it just organically. What are some of the dangers or risks in doing roll-up or bolt-on acquisitions? It could be that there could be a clash of cultures, that the managements have different styles of doing things, and this could be, it could also be where you buy a local competitor who, instead of being integrated, remains a competitor. And we may have the deal makers, so the management are good at buying companies, but not good at running the companies, or vice versa. And so these are all some of the pitfalls you might find with doing bolt-on acquisitions. And so the key of doing a successful bolt-on acquisition is to be able to do the deal successfully, but also to be able to integrate it after we have done the acquisition. What are some of the main success factors with doing a roll-up? This would be trying to replicate what has been done already, using best practices and taking costs under control. The usual main two problems you find with bolt-on acquisition are going to be overpaying for the acquisition and a lack of management resources in order to integrate the acquisition properly. And one of the things we must always remember when we do a bolt-on acquisition as part of a private equity bolt-on strategy is that we must remember to calculate the integration costs, because you may have synergies from combining the two businesses, which is why we've done the acquisition in the first place. But we mustn't always neglect to factor in the integration costs. And these integration costs could be very high if we don't have the management resources to efficiently integrate an acquisition. So, what are some of the main success factors in any roll-up? It's going to be management, which is dedicated to the acquisition, which is able to support it, being able to learn, being able to identify middle management, capable kernels, and implement the hard decisions that need to be made fairly quickly. And on the employees' side, it's important to make sure the employees are not overly anxious about any kind of roll-on acquisition that may take place. Okay, let me say a few words now about the deal making that would happen, that we're expecting in the year 2020, now having discussed a few deals. I think what are some of the relevant things that are important to bear in mind? Firstly, that there is a considerable amount of unspent capital in the private equity market. So some of the buyout funds in particular have a considerable amount of dry powder, and so there is that capacity for private equity funds to come into the market, but they're going to be waiting probably for the second half of this year. So on the large buyout segment, the funds have a large amount of capital. And remember, as I mentioned yesterday, that about half of all the capital raised for the private equity sector was raised by about 50 or so mega buyout funds, and the rest of the capital was shared by some 7,500 mid-cap private equity firms. The mid-cap market, so the market of deal sizes ranging typically between 5 and 50 million, so not the buyouts, but the kind of the growth type investments. This market is pretty much frozen along with the venture market because we have the valuations are not in equilibrium, because on the sell side they are waiting, and on the buy side they wish to buy less, but the sellers are not yet moving. But we will see the eventual buy and build, the eventual bolt-on, which I just described, of companies with a weaker owners. And so companies with private equity ownership have the benefit of a strong ownership, whereas other companies that may have like a single group of founders or something such as that may end up being in a position where they need to merge in order to survive. There's quite a few companies out there that were founded some 10 years ago, so the founders of these companies are perhaps relatively younger or have no experience of going through a crisis or a downturn. And many of these companies are now quite vulnerable because the founders and management of these companies have only been used to the good times and of growth, and find themselves in difficulty. And some of these companies who have been more difficult in terms of their negotiations with private equity firms may become much easier and become much more flexible in 2020. So I'm expecting a lot of deals to happen in the second half of this year. Another important part of deal making is that we can expect a good number of private equity fund managers to stop doing so many deals, but to focus more on supporting their portfolio companies, something which I'm going to talk about more in the second session after our break. What are some of the deals that we're seeing now in 2020? Well, there've been a number of deals that did happen in the first quarter, which were mostly leftover deals from 2019 pre-corona. But the new deals that have happened in the market have mostly been debt deals. So private equity funds, particularly the larger buyout funds, coming in and buying debt rather than equities, and buying this debt at a discount. So acting as more like a debt fund than an equity fund. We've seen a number of preferred instruments. So the investment's been done as a preferred share in order to guarantee themselves against some of the downside which may be imminent because of the current situation. And it's still too early to see any specific trends in sectors. There's talk about remote medicine, like people getting visited remotely. There's e-commerce, but we really have still 2 months of data, and so we've got 2 months of data more or less, and that's important data, but it's still a little bit early for people to really be able to be clear on exactly what trends we might expect. You know, I was earlier this afternoon, I was participating in a webinar with a group of venture capitalists, and one of the questions was, well, what about things like the people doing workouts on Zoom? You know, so for example, you go on Zoom and you do a yoga workout connected to people, and many people thought, well, that's just going to disappear once the crisis is over. That's not going to last because people are just going to go back to yoga classes. So we have data, but it's still a little bit early to be absolutely sure what can happen. But some areas there is evidence that there will be some trends, like, for example, remote medicine. So, for example, in the UK, where the government the National Health Service, so the government health service was very sceptical about remote visits to doctors. They had no encouragement for it. And because of Corona, they've suddenly changed that, and they're going big time. And so the government is, as part of their healthcare policy, is pushing for that. So we are going to see some changes. So it'll be very interesting to follow that in the next 2 months and see where that gets us. Okay, so that concludes my words about deal making in private equity and some of the trends in deal making in 2020.